In this video, we're going to talk about some important terms that you need to know and should have a good understanding around if you're going to get started investing or get going investing as we go into 2025. My name's Nate. I'm a popular investor on eToro. I've been investing just over 10 years. It's been a great journey. Had a lot of ups and downs and experiences, but overall had some good returns, some great years, had some rough years, and it's been good. I do want you to know that this is not financial advice. I don't know your exact circumstance. I don't know your financial goals, your risk tolerance, all that kind of stuff. So this isn't financial advice for you. These are just things that I've learned along the way, things that I like to do. I like to talk real money for real people, okay? And if you do want to get started investing or you want to know more about eToro, jump in the comments below. If you have any questions about any of the terms that we talk about today or about anything around investing, finance, budgeting, all that kind of stuff, again, comment below. Probably do a video on it as well as reply to your comment. Now, I do want to say right up front, this is not an exhaustive list. Okay, this is not a exhaustive list of every term that you should know, but these are some terms that you're going to come across as you get started investing, and it's handy to know what they mean. So let's dig straight into it. The first is leverage or leveraging. If somebody talks about leveraging their position or leveraging their money, it's helping them lift more and or invest more with less capital or less of their own money. It will send your risk score in the investment world through the roof, especially depending on how much leverage you use. Let's talk about an example. Let's say you put in $1,000 invested into the S&P 500 and you say you're going to do that at 2 times leverage. It's like putting in $2,000. If you're going to do it at 10 times leverage, it's like putting in $10,000. And the risk is sometimes people do this with things like crypto or stuff that has a lot of fluctuations, a lot of movement through the days, through the weeks, and it can have a big drop. And when you're holding a leveraged position, if it drops too much, you actually need to put more money in to hold your position open, to keep your position open. Otherwise, they will lock in the losses, close your position, because you're running not just a risk for yourself, but also that you could end up owing a debt to the brokerage that you're running it through. So leverage will send your risk score up. It is something that I tell majority of investors, and I myself, leave alone. I'm interested in long-term gains, in being very confident and comfortable and understanding what I'm investing in. And I tell other people, if I don't do it, I wouldn't recommend it for others, okay? So understand what you're doing. The second is gapping. Gapping is what's used when there's gapping is what happens when a day finishes and the next day starts. It's that in between. So the markets will close, but the hours of business and trading and the stock movement will change after the market closes. Let's say Apple, for example, gives their earnings report. Its stock will fluctuate. Let's say it closes at 105 on a Friday and it opens at 106 on Monday morning. That dollar is a gap difference, okay? So that's a gap difference, just shy of 1% gain difference, right? Let's say you owned it into the close, you would see that dollar gain. But if you didn't own it and you bought it, put your order in over the weekend or after the market closed on Friday or before it opened on Monday, the pre-market, you put your order in, your order would be executed at $1.06 when the market at $106 when the market opens. That dollar high, you would miss out on that portion of the gain. I did a video on the gap trap, on how this can catch you out and it can actually damage your investments significantly if you're not aware of it. Let's jump now to ETFs. If you're seeing this video, chances are you know what an ETF is. Exchange traded fund. I won't spend a long time here, but essentially it is a basket that holds a lot of companies inside that basket. You can get cross-sector ETFs like the S&P 500 that has 500 companies from 11 different sectors. You can get sector-specific ETFs like URA, which holds companies that are solely focused on uranium, or CIBR, which holds 34 companies that are focused just on cybersecurity. You can also get dividend-producing ETFs like SPHD, which takes 50 companies that have the highest paying dividend and lowest volatility from the S&P 500 and puts them into one ETF known as SPHD, or high dividend. The name will give you an idea of what is inside that ETF. And then look at the companies that are in there, and it will show you where that ETF focuses. So that's ETFs. CFDs stands for contract for difference. So if you have a CFD, and if you're investing with leveraged positions, you have a CFD. You won't own the underlying asset. Now, CFDs are fine. You just need to read up on your brokerage and understand what leverage means and what it means. But most of the times, and I've held CFDs with eToro, they weren't leveraged, okay? But for the working with eToro and at the time, it was a CFD position. Now they've actually moved to where you own the underlying asset, so own the underlying assets. But CFDs just stands for contract for difference. You have a contract with the brokerage. That's what that means. Okay, you don't actually own the underlying asset, but you have a contract with the brokerage. If it's a reputable brokerage like eToro, which I believe is, you're going to be fine. Last but not least is long and short, or buy and sell. You're going to see these two terms everywhere, okay? Long or buy means you have bought an asset, let's say Apple again, at $105, and you, as if the stock prices, if the asset price goes up to 106, 110, you're going to see that return. You're going to see that gain, and your value of that stock price will go up as well. Your value of the money that you've invested in that stock will go up as well, or into that ETF. Shorting or selling, which has its risks, I'm going to go into that in a moment. Shorting or selling means if it goes from $105 to $100, while the stock price may go down, your value will actually go up, okay, because the stock price has gone down. I'm not going to go into huge details as to why that is, but you're essentially betting that the value is going to come down from where it's currently at, and that it shouldn't be valued at that current valuation. The risk here, let's say you're buying, the lowest you can go is $0, okay? The lowest company goes from $100 to $0 and gone, poof. It means you've got no money left, and that's not very nice or fun. We don't enjoy that. That's not it. We don't want that. But it does happen sometimes. Companies, believe it or not, go to $0. Selling, however, or shorting, when the price goes up and you're shorting a position or selling a position, if the stock price goes from 105 to 110, you've actually lost money. People that are buying have made money, but you've actually lost money. Now the ceiling, while the base is $0 for buying, the ceiling, there's no cap to that. And so you could find yourself in what's called a short squeeze. And we've seen that, we saw that with, you remember the GameStop saga and different things like that? We've seen that happen. Bed Bath & Beyond, it happened with them as well, where there was some short squeezing and stuff happening. And people actually struggled getting out of their positions. And so they end up losing a lot of money, and even more than what they had put in. So it's risky. So I put shorting and leveraging. These are two things that will put your risk score up, okay? I like to hang my risk score between a 4, 5, it dips down to a 3 sometimes, but between that 3 and 5 is usually where I hang out, which means we have a good foundation of cross-sector ETFs. We have that foundation there, and we may branch out from there a little bit, but we can always come back to that foundation and see some solid returns. If you want to see a portfolio breakdown, I did a video on that earlier, a week or two ago, and you can see that video on the channel. Hey, thanks for watching. If you want to get started investing, drop a comment below. we can talk on there, and happy to help you get started on eToro. I do recommend it. It's a great platform. I've enjoyed my time on there, and they're not paying me to say that. I am a popular investor with them, and if you're not sure what to do, you can actually just copy my portfolio on there. Thank you to all those that do copy my portfolio. If you haven't subscribed or followed along on our YouTube or TikTok channels, please do so, and we'll see you in the next video.